Hello and welcome to the Business of Betting podcast. Today I'm joined by Plus EVBettor George. George, thank you very much for joining me. Before we get into this episode, make sure you follow us on Twitter @BettingPod and check out the website businessofbetting.com. Guest suggestions are much appreciated. This podcast is proudly sponsored by Betfair Proprietary Limited. Betfair operates a betting exchange and is licensed in the Northern Territory of Australia. Residents of Australia can join Betfair by visiting betfair.com.au and support this podcast by using promo code BOBPOD. Please gamble responsibly. So thank you for listening, and I hope you enjoy this episode of the Business of Betting podcast. Today I'm joined by Plus EVBettor George. George, thank you very much for joining me.
Hey, how's it going, Jake? Good to be on.
Thanks for coming on. So, George, set the stage for us. What led you into sports betting?
Yeah, so I started my career down a traditional Wall Street path, sort of at a standard investment bank in New York, and then went into private and public market investments at different funds, private equity, hedge funds, doing public market investments on stocks. And over time, something that I always did in my spare time was bet sports and try to gain an edge in that. I've always done things like count cards and play poker and play games that I think are inherently fun against other people that just spoke to me. And so took a career path that led me to sports betting. From there, applying a lot of the finance skills that I had developed early in my career. So that's sort of where I landed the past few years, was building quantitative sports models and betting and working with some other guys in the sports betting arena.
Did you have any mentors or people that you looked up to throughout that time, especially sort of transitioning from, Wall Street, private equity, hedge funds, that type of thing, and over to sports betting, or was it pretty vacant and empty in that sort of arena?
I would say the biggest thing is through reading. I mean, there have been, from Bill James, which I'm sure everyone's familiar with, who listens to this podcast, and Sabermetrics, to especially around football, there is a book by Chris Brown that talks about, sort of the analytics of football, to Dean Oliver, so just getting sort of the insight into the thought leaders in the sports analytics space helped me get insight into how I could apply financial techniques into the more domain expertise of sports analysis.
Were there lots and lots that you found, or was it, Bill James, Joe Peter, Ed Thorpe, these types of people that existed, or was there sort of a plethora of options and you had to sort of dig through, and there might have been varying approaches to football, for example? I know, some of the books talk about, when to go for it on fourth down, the difference between, taking a knee in the end zone and starting at the 20 or 25 yard line versus, taking the ball out, all that type of stuff. Was there not necessarily peer-reviewed, but a varying approach to those things, or was it pretty much there was a handful of people that stood out?
The biggest thing is the thought leaders in the sports. I wouldn't say that there are, and it's continually evolving. I mean, I think there's a lot of guys out there who do great work in terms of sports analytics as it relates to certain sports, especially with football. I think they're especially now with play-by-play data being so prevalent, it's changed from what football analysis used to be. So the seminal book on football analytics was a book by a man named Chris Brown, and that was written in, I think, 1989. And as data has gotten more and more granular, the techniques, just like in any industry, have changed. So you continually have to find either develop techniques yourself or find people who are doing the same sort of things and learn from them about what what's cutting edge and what can give you an edge in any sort of market that you're trying to participate in. So I would say that the type of people that you're trying to learn from is continually evolving, but sticking with the classics of, the Dean Oliver, Bill James, Chris Brown's, you can then build off of that. And with any new techniques that you have, with you yourself have in terms of, data science or, financial analysis techniques, that you can then apply that domain expertise to those fields.
Yeah, it's interesting. It's certainly a great foundation. I'm curious, you mentioned, the different techniques. Was there a large knowledge transfer from finance to sports betting initially, or did it take some time?
I think anytime you are talking about trying to find expected value, you're going to have the same general mindset of, I'm trying to buy $1 for 90 cents, right? So I'm trying to bet on the Patriots are at -7. I think that the line should be -10. So there is value in betting on the Patriots. Or when you're investing in a stock, it's figuring out, hey, Apple is trading at $100. I think it's worth $150. So it's that same mindset of figuring out, hey, I want to buy $1, but I only want to pay 90 cents. So it's, figuring out where there is market mispricing, basically. That is the main core tenet of sports betting, investing in general, just finding those positive expected value situations.
When you start out with a sport, take us back to the very beginning when you're sort of building out a process. Let's take NFL, for example. Where do you start? If you've read a book or two, you might have been a fan, you understand the game, and then you get into sports betting and you, for whatever reason, let's say you have to bet sports betting as your full-time job now. Where do you start? What are some of the things you're looking at in the very beginning to build a framework to be able to find those plus EV bets?
Yeah, no, that's a great question. I think the main thing that you want to do when you look at a sport is finding those leverage points of variance. And if you can find those and strip those out, I think you're going to be ahead of the game. But what I mean by leverage points of variance for something like football, it's figuring out that, hey, what's predictive versus descriptive, right? So something that is descriptive of what happened is maybe a team fumbled the ball 3 times in a game and lost by 21 points. While that's descriptive and accurate of what happened during the game, that's not going to be predictive going forward, right? Because negative turnover differential has shown to regress towards basically zero. There's no predictive value in something like turnover differential. So being able to strip out things like that, like turnover, fumbles, interceptions in football, or 3-point shooting in basketball, or finding these leverage points in different sports and basically distilling, hey, what is the actual skill that can predict this sport going forward is the first thing that you want to do when you're trying to break down and say, hey, I want to properly analyze this match and determine how good is this team really, is taking out that those high variance leverage points that may tell you that a team is won or lost a game, but is not going to tell you if they're going to win or lose in the future.
How often do those leverage points of variance you talk about change or develop, and are they literally the same, but as the market catches up to them, the edge in them disappears and you have to find the next iteration and the next iteration?
Yeah, so that's exactly correct. A lot of these things will get priced into the market. A lot of these things that are talked about, like turnover differential. Another one that may be less well known is something like explosive plays, which determines, if, for example, an 80-yard touchdown run that probably would have happened from 50 yards out, but they get credit for the 80 yards, so that's going to increase a lot of the statistics for that football team. So continually finding these sort of high variance or alpha generating edges is what investing or sports betting is all about. Finding finding them and then figuring out if they're priced into the market, and then continuing to find more, because as data gets more and more granular and people are able to get, play-by-play data, they're able to get, spatial, I worked with an NFL on a project and we got, spatial coordinates of players, XY coordinates. So as the data gets more and more granular in terms of what you're able to analyze, you're then going to see more and more of these edges be exposed in terms of figuring out how to distill that data.
Does that ever end? Is that just a continuum that just continues on and, there's new edges to be found, although the markets will be efficient and get more efficient, but there'll still be new edges to be found, and as certain things get priced in, they sway along the line, but ultimately it's a continuous process? Yeah,
so the thing you have to realize is yes, it is sort of, there is an asymptote to which, you can accurately predict games, right? There is a randomness component to sports, which, makes them inherently fun, which you don't know which team is actually going to win, that just will never be able to be predicted. And then there is that skill portion of the game that, everybody is trying to determine accurately. And that is going faster and faster, but there is a limit to which there is, say that, in football, we've determined that there's something like 25 to 35% of the game is based on luck, right? So if you can determine, 25 to 35% of the time within a game, this has a lot to do with how long a game's played, number of possessions, things like that. If you can determine how much of that luck comes into play, you can accurately determine, hey, what is the maximum likelihood, what is the maximum probability that I can accurately predict this sport, right? And it's different for basketball versus football versus soccer versus any of these sports. There's a different variance component that these sports have that, as someone who is trying to predict outcomes of matches has to take into account that, hey, there is a limit. You'll never be able to be 100% against the spread in any sport because of that randomness factor.
And is that a multitude of factors, or is that, total, like NBA, for example, there's a lot of possessions versus NFL where there might not be more than 30, for example. And in soccer, there's very low scoring. So how many factors go into finding out what that randomness component might be?
So there are a lot of factors that go, and it varies from sport to sport. You wouldn't be able to just pinpoint it for one sport. So for instance, in football, a lot of breaking down the game of football is figuring out how good a quarterback is. And because he is going to quarterback that offense, he's going to literally touch the ball every time the offense touches it. Now, whether he hands it off the running back or throws it down the field, calls an audible at the line, that sort of dynamic that quarterback has is going to influence the skill of that team. Whereas in basketball, there are 5 players on the court who can equally contribute in a certain way. On a football pitch, there are a certain number of players that, like you said, there's low scoring, and then a certain number of times that a team touches the ball, like you alluded to, is going, the number of times a team touches the ball just hones in on the actual skill of the event, right? It's like if you flipped a coin 5 times, you could easily get 5 heads versus no tails. But if you flipped it 100 times, it's very unlikely that you're going to get 100 heads versus 0 tails, right? So the more possessions you play in certain sports just sort of crystallizes the actual skill level of that team, which is why the Golden State Warriors are very unlikely to lose to like the Sacramento Kings, whereas the New England Patriots could very well lose to any team on any given Sunday.
Do you have a preference in terms of, I guess, the skill and the luck components and being able to crystallize it down like you mentioned? Do you prefer to bet on events that have, more randomness, let's call it, versus less, or is it just about picking the sport that works best for you?
It's not about, for me, it's not about, it's exciting in a method of, this has more of a luck component, it's more fun to watch, or this, it's more of a function of, if I'm doing this as my job and I want to make money, then, where I have the most edge, right? So if, football's a great example of a sport that, while it's well known and well followed, because it's a unique sport and that it's so publicly bet in the U.S., you will be able to find a lot of value throughout the season. Or small market college football teams, lines just won't be as sharp on these teams. So, if you're going to ask me what I enjoy betting most, it's where I can find the most value is what I would enjoy betting most.
Got it. Tell me about context. A lot of people I talk to mention it. What are your thoughts on, when putting together your models and analysis, the idea of context around plays or possessions or whatever it might be?
Context. So, yeah, it's hugely important to, I guess, in terms of the process of building a betting model. And again, this is just pruning your data set so that it's a quality data set, right? If a team is up 35-0 in the fourth quarter and they have their second string quarterback in, are you going to count the 80-yard touchdown pass that the second string quarterback threw for? Is that predictive going forward, right? Probably not. So you want some mechanism to throw that out. So an easy way to do that would be, like you said, the context of the game. Say, hey, I'm only going to look at plays within where a team is within 21 points before the third quarter or something like that as my predictive data set going forward. So that's just, so there's that portion of using quality data going forward. And another, I guess, maybe what you're referencing is sort of, something that's well known in the football analytics community, which is success rate, right? A successful play on first down, 5 yards is a successful play on first down, or 1 yard isn't a successful play on first down. But if it's third and inches and you get 1 yard, that's a successful play, right? So context in that down and distance scenario definitely has a huge impact on whether a team was efficient or not.
Okay, that's interesting. Can you dig in a little deeper on that? Obviously, it's very intuitive. If you're following your team and it's 3rd and 3 and there's a 4-yard run, you feel good in your bones because you got another setup down. So intuitively, it makes sense. The context of the game is obviously relevant and important, but why? Just take us through why that might be predictive, or why efficiency is so important from a broader aspect as well, not just that individual play. And is it just that that's high leverage, or it's a high importance play and therefore it's more relevant versus the 9-yard touchdown run down 21?
Right. So it goes back to figuring out the skill of a team, and you want to figure out what the goal of this team is, right? And the goal of the team isn't to just churn yardage out. The goal of the team is to score points, keep the drive going, in this case, right? And so it's just using the right metric to measure this team. And so instead of saying, I want to use yards per carry to measure a team, you want to say, I want to use success rate to determine the efficiency of the team, right? And it's saying using things like success rate, using things like win probability added, expected points added, these statistics that more accurately reflect what a team is really trying to do versus just gain yardage, right? Because I think as fans, we're conditioned by what we see on TV, where they show, this running back averages 4.3 yards per carry, to say, okay, whether that's a good running back or not. But a much better way to measure the context of a running back would be to say, hey, this running back is successful on 60% of his runs. That, to me, is the way to measure the quality of a player or team. So it's so when we talk about context, it's just using the right metrics to measure is how I would think about it.
Yeah, so you're essentially creating or recreating your own preferred metric, which would be, based upon things you value.
Exactly. And this goes into sort of domain expertise on knowing what's important in that sport, right? When you know that getting a first down is more important than getting a lot of yardage. In a 3rd and 18, if you only gain 10 yards, the defense was probably giving you that 10 yards. But on a 3rd and 1, it's going to be a lot harder to get that 1 yard because the defense knows that you're going to try are more likely to try a run. So yeah, it's determining what is actually what is the actual goal of these teams and measuring that is going to help you a lot in building out models and measuring the success of teams.
So in terms of finding what's predictive, do you have a specific process to validate? You might have picked a stat you mentioned before, I think explosiveness, and certain statistics might, generally regress back to the mean, and, whether it's turnovers or fumbles and things like that, fumbles recovered. Do you have a process you go through when whether it's you found a new statistic or you're going through something in the off season that you can share with us in terms of trying to determine if it's predictive or just descriptive?
Yeah, so this is just pure statistics and finding things that have statistical significance in a T+1 scenario, right? And if I take the previous data, is going forward, is what this variable or factor that I've pruned out, is this going to help me in the future determine whether is this repeatable in the future for this team, basically. And even if it's not repeatable in the sense, then that's still instructive, because for a thing like turnovers where it's not repeatable, you can at least say, hey, well, then there's a high regression component that can then be factored into this variable. So just it's basic sort of, I think, statistics that any person would look at. There's p-value testing. There's a lot of different statistical significance tests that you would do to figure out, hey, should I use the cross-validation? Should I use this factor into my model, or should I prune it out? Should I reduce the number of factors? So it's a whole process that any analyst would use in any field to say, hey, is this going to help me going forward? Or is this just an interesting stat to look at?
It's a bit of a random question. Momentum in an NFL game, let's say. Do you believe in that idea of momentum, or do you think it's just whatever happened was, within a couple of standard deviations of happening anyway, so it's not momentum, it's just what could have happened? So whether it's, the Patriots-Falcons Super Bowl where, if you're at the stadium, it felt like they were going to win, and if people that believe in momentum would say, yeah, it was just all momentum, they kept scoring, 2-point play, they won the toss for overtime, they took the ball, they didn't do any crazy Belichick thing, and they won the game, and there was a lot of momentum involved. How do you think about the idea of momentum? Yeah,
I think that's a question that's been explored a lot, and I think that it's another way to sort of phrase the hot hand theory, right? Does that actually exist? And there's literature and there's studies going both ways. I fall into the camp that you're going to I fall into the camp of you have a prior that is going to be constantly updated in a Bayesian approach, but that prior still holds the majority of the weighting in terms of what a team or a player is going to do in the future. So there will likely be some regression anytime you see one of these small sample size streaks in terms of a team doing really well, whether that's making a lot of 3-point shots or completing a really high percentage of passes. I think that you have to take into account that, at some point, the regression towards the prior is going to come into effect. So,
yeah, it's an interesting one. There's many different takes on it. Question on how often you update your model and modify and tinker. Would your NFL model from, let's say, 5 seasons ago, untouched from back then, work today, or is that a long way off?
There is, so that touches on the point that we talked about earlier, Jake, in terms of just what you call in the finance world alpha decay, right? Anytime you have a strategy that works, people are going to exploit it until it doesn't work, until it gets priced into the market. So if you had, it depends on the model that you had and what the factors were in that model. Because a lot of times when something works, it's only going to work for, a certain period of time before everybody knows about it and everybody starts betting it in. Then the lines start adjusting or the prices start adjusting, and there's no longer any value in betting that certain way. So a lot of it comes down to how you built your model. Was it sort of a fundamental model that is trying to measure team strength, or was it a more technical model trying to take advantage of some factors that you thought that were significant back then, like in the early 90s, betting home dogs would have been a model that would have been very profitable. Betting home dogs now is not going to be a profitable model, right? But if you had a model that was looking at evaluating team performance in the 90s and could accurately measure that with certain metrics, that's always going to have value going forward, because you're always going to want to be able to accurately measure skill for the reasons we touched on earlier, to determine an accurate price for the game that's being set.
So do you think you need to do something unique in order to win, and especially long term, or do you think being disciplined, smart, calculated in how you put your model together, and then obviously bankroll management needs to be sound, in terms of something special or unique, do you need that to win, or do you think it's something that's obviously great to have and it might push you from 54.5% to 56%, but ultimately there's a path to win without being a genius?
I think if you can't, I would say this, talking to sportsbooks directors and being in the sports betting industry for a while, probably around 98% of sports bettors lose. And I think what you mentioned first in terms of bankroll management, that's the first thing why people lose. Another reason is they they have to find an edge, and some people are just going to be coin flippers. It's going to be a random coin flip, and the book's going to charge you 110 to win 100. Anytime you are laying 110 to win 100 and you're flipping a coin, 70% of the time, if you flipped a coin 100 times and you laid 110 to win 100, 70% of the time you would be a loser in that situation. So that right there is sort of table stakes, is finding an edge. If you can't find an edge, you will likely be a loser. If you can't quantify that edge, then you won't be able to have proper bankroll management. And it's especially hard in sports betting versus, say, stock investing or financial management, because these are binary outcome events, right? The Patriots are either going to win or lose. You're either going to win $100 or lose $110 on Sunday. And this is a very hard concept for most people to grasp, even professional money managers to grasp. There was a paper written by a man named Victor Hagani, who was a partner at Long-Term Capital Management, which is I don't know if you're familiar with that.
Yeah, we did an episode with Victor, actually, I think around this study.
Okay, awesome. Yeah, so exactly that, where then you'd probably be able to say it just as well as I would, but you could give people the day's news, and because they couldn't properly manage their bankroll, they are going to end up losers, right? I think it was something like 30% of the people one third of the people who were flipping a weighted coin, 60%, 40%. So I'm telling you, you're going to have 60% winners. One third of the people are going to go bust. I mean, that's just how important money management is in terms of A, staying in the game, and B, minimizing drawdowns and maximizing profits.
Yeah, it's an amazing thing to read when you haven't thought about it, I suppose. Even though, a lot of people who are listening are probably very well equipped to talk about Kelly criterion and talk about overbetting and talk about these things. And then you read this paper and you think, wow, I didn't know that, or that seems wild, or there's no way that would have happened. But I think it was episode 21 we did with Victor where we talked about the paper and talked about even in many situations where you overbet, it doesn't matter. You're just going to lose and you're going to go bankrupt.
It's there's actually, this is a concept in quantitative investing that we talk about a lot. It's a term, Victor eloquently put it in that paper by doing that study showing that people don't know how to properly size their positions. But it's a term called vol drag, where, if I gave you a game where you're up, if you win, if we flip a coin, you win, you make 10%. If you lose 10% of your portfolio. But 51% of the time you're going to win, and 49% of the time you're going to lose. 99% of the time, even though it's 51-49 in terms of winning, 98% of the time, or 99% of the time, you will end up a loser, because that distribution of the winners is they're skewing that positive expectation so much that everybody else is a loser, because there's too much volatility in your bankroll. Basically, the drawdowns are much too high for the amount of capital that a person has. So being able to properly manage your capital is imperative and necessary even before you talk about finding these edges in the sports betting market.
Yeah, it's really hard, especially when you look into some of even when you read all the literature. If you've probably read Poundstone's book Fortune's Formula, and you hear from the Ed Thorpes of the world who have done it for a long time and been very successful, and you read Victor's paper and a few other things, and you're talking about vol drag I haven't heard of, but there's a lot of different things out there that when you try and put it all together, and how do you manage your bank? I ask people whether they have a bank for every sport they do, how often they recalculate the bank to find their unit sizes. Do they do it every day, every month, every season, every year? And there's a lot of different components that go into it. And one of them is, if you have large drawdowns, you still got to work your way back up to get back to square oftentimes. And there's a lot of problems within that in terms of understanding what your capital is, what it might be, the chances of it going one way versus the other, and so on. And a lot of the outcomes are very bad and end up in being bankrupt.
Most of them do end up being bankrupt, even if you have an edge, and that especially is true in these coin flip or binary outcome situations. And even the best sports modeler, even the best is going to be very hard pressed to accurately tell you their edge on any given outcome. They may have a range of edges that they could tell you, oh, I think I'm, this game has a 3 to 5% edge for me. But the reality of it is that it's very tough to predict that, and they're probably being over aggressive in what they think their edge actually is, and that many times, even for the smartest people, the best well-informed, the people with the most information, they could still lose because it's going to kill them in bankroll management.
So one more question around the betting process. Analytical approaches and situational approaches, do both of them work in your mind, or can you use one or the other or both combined to win long term?
So can you explain to me the difference between analytical and situational approaches?
Yeah, so analytical is I create a model. It spits out my, Patriots -7 and the market's -10. I'm going to bet on that, and then bankroll management is separate. Situational might be, in the past people talked about West Coast teams going to the East Coast, playing, in different time zones, things like that, or having a week's rest, or playing Thursday night and then the following Sunday, or going to London and coming back, all those types of things that are difficult to quantify, seemingly.
Right.
Or attach a value to things like rest and things like, Andy Reid off a bye and all that sort of stuff. Some of it's easier than others, but a lot of people, certainly in the US and certainly in NFL, there's a large contingent that seem to focus on a lot of the situational stuff.
Right.
A lot of people do both, and they have a strong analytical model, and then if they factor in, well, my model says -7, the market's -10, and this team played on a Thursday night, so that is an additional half point or whatever they come up with. How do you think about the analytical and the situational?
Yeah, I think there's a great corollary in the world of finance. We call in finance, you call it fundamental versus technical investing, right? Where fundamental investing is looking at the intrinsic value of a company, how much cash flow will it earn, what are its future revenue projections, et cetera. And that what I would equate to what you call analytical sports betting, where it's a bottoms up approach where I'm trying to determine the intrinsic value of this team or stock. Whereas technical investing doesn't care about the intrinsic value of the stock. It's looking at things like momentum, right? It's looking at technical indicators that have nothing to do with the stock itself, and I guess you would call those situational investing, situational betting. And I think that there is a sort of intertwining between the two that really can show some benefits. Anytime you can combine things like value plus momentum, or you combine a bottoms-up approach with situational approaches, and you can find value in both those situations, then you are going to just increase your edges that you're able to find in a game, right? And again, I think I think football's a really interesting situation where it's 16 games in a season, right? And any person who's running a strength of schedule model, you won't be able to accurately tell someone's strength of schedule until week 4. So those first 4 weeks of the season, you're basically just using the priors from last season and a sort of thumb in the air estimate on how good you think that team is versus another team. Any serious NFL bettor, those first 4 weeks of the season, is using almost purely situational trends, because it's almost impossible to determine, because of the high turnover rate in terms of players on teams, and determining the impact of rookies and things like that. It's almost impossible to accurately determine the true skill level of that team. So in the first part of the season, you're almost purely dependent on these, what you call situational factors. But as you get later into the season, you're going to use more of a blend of fundamental plus technical investing, or I guess you called it analytical plus situational investing.
Rethink the way you see sport. Every action or play can be represented by a series of numbers. When you analyse this data, patterns begin to emerge. If you follow these patterns and develop systems, you can play the game within the game. Betfair.com.au. Gamble responsibly.
So I've heard people talk about, and I've had guests on here talking about, the sports betting, given it's uncorrelated to the markets, could become, or may become, whatever you want to use for that, an asset class that people would be interested in. Given your background and what we've spoken about already, what are your thoughts on that topic? Could it work in the US? There's obviously issues with getting enough volume down and all sorts of things like that, but as we move towards, or much more towards, a global marketplace, and and the idea of an asset class of sports betting, whether it be a hedge fund or whatever. What's that mean to you, and do you think it's feasible?
Yeah, I think it's absolutely feasible as an asset class. It has, a characteristic that you mentioned. It's a truly uncorrelated asset class that is very hard to find in other arenas. It's also a drawback, right? Because there is no beta or market. So when the economy is doing well, you'll see things like real estate, stocks. A lot of these asset classes, correlate well together. But in recessions or downturns, beta goes to 1 for all those, and they all do poorly, right? So you don't get any of that, and that's good and bad. But it also means that you can't just invest in an index fund in 1920 and compound at 6% a year by investing in the S&P. So it's a pure something like sports betting, and as it moves to more peer-to-peer exchanges, is going to be a pure alpha generation game where it's me versus you. If I'm winning, that means you're losing, right? So as an asset class, it's going to be that's going to be the one thing that's going to be difficult for it to grow past a certain limit because, in the case of stocks or real estate or things like that, there is, as the economy improves, more people get more money, and there's more money to go around. And when you're talking about sports betting, you're either beating the house or you're beating another person, right? So that's the one thing. While there's a lot of benefits if you're good at it, it's like a skill that you can have counting cards, where you can continually have a proven edge and continue to make money if you're good at it, and that's great. But billions of dollars in the asset class is going to be far-fetched because of the fact that you just can't index, and it is a zero-sum game in the end.
So bookmakers, do they set line to get even action, or do they set lines to maximize their profitability?
Absolutely the latter. I mean, there's been, these bookmakers have been in the industry for a while, and they know better biases. There was a paper by Stephen Levitt, the author of Freakonomics, who detailed this. Basically, books will absolutely shade their lines because they know that there are public teams, that there are, people like to bet favorites, people like to bet certain biases. And that's why you see people say, oh, if you just bet the, counter consensus, you'll do pretty well. And that's generally true, because when you're betting the counter consensus, you're betting with the house. And the house has, in the current sports betting model, the house has a lot of experience in knowing where action is going to come. And so they are able to shift a line a certain way so that, because they know the action is coming that way. So absolutely, it's a fallacy that they're looking for 50-50 action on both sides.
So let's talk about the Score Exchange. What can you tell us about it now?
Yeah, so the Score Exchange is a project that I've been working on with a couple of other guys where, we think that the American sports bettor is getting a raw deal. Even with the regulation that surrounds gaming, which is evolving, the current regulation and the industries in place have constricted sports betting from evolving. I mean, you wouldn't never think about going to a stockbroker to place a trade, a physical, you would never go to Fidelity or Goldman Sachs or anybody like that and say, hey, I want to buy Apple stock. But as an American sports bettor, you don't think twice about going to, the Westgate or whatever sports book to place a sports bet. So, I mean, already you can say that the sports betting landscape is very unevolved from that standpoint, and from the brick and mortar standpoint, and from the standpoint of expenses, right? Having, like we talked about earlier, having to lay 110 to win 100 is something that has to be a relic of the past. I mean, these high margins from sports books will have to come down as competition arises, as sports, you know more about this than me, Jake, but as sports sports betting regulation gets in place state by state, you're going to see more and more competition from betting exchanges and untraditional sports books that will lower these margins for players. And then it's also sort of real time, anytime, where domestically, a lot of what we talk about are pregame bets, betting before the game happens, where internationally, it's much more prevalent to see in-game wagering, live lines, things, being able to bet, on your phone anytime. And so that is why we created the Score Exchange, to sort of hit on these points in terms of the end goal is to make it a peer-to-peer exchange where you trade sports teams like stocks. And the value of the sports teams are performance derivatives based on how well the team does that season. And this does, it's simplistic in its nature, but it does a couple things. It allows fans to easily bet on, say you were a fan of the Patriots, bet on the Patriots for the season without having to continually say, hey, I wonder if they're going to cover -7 this week or -13 next week, or should I lay the money line? Being able to just say, hey, I want to invest in the Patriots at, $25 a share and roll that and hold that until the Super Bowl ends is what we think is a better mousetrap for the fan to invest. And, right now we're not accepting real money. It's a simulated market exchange where we're giving out prizes to people who can win in this game, a lot like fantasy football or pick'em, where you start with a budget and you try to grow your bankroll, and we're giving prizes to incentivize players to play to accurately predict these games. In the future, we want it to be a true peer-to-peer exchange where a fan can invest in the team that he's rooting for without having to think of vig, money line, et cetera, that, as we talked about earlier, makes the game almost impossible to win, which makes, unless you are spending your full time and doing sports betting, it's a very difficult endeavor to be profitable for a lot of the reasons we mentioned earlier in the podcast.
So how do you solve, and few issues come to mind initially, how do you solve the user experience? Obviously, not everyone's an expert or understands completely the stock market necessarily.
Yeah.
And two, the endpoint. Obviously, there's an endpoint in the season. Do you get, the equivalent of dividends if your team's doing well? Do you get some sort of amount at the end of the season based upon maybe season wins? And if you exceed season wins, things like that, how do the payouts work, and what are you valuing, or what is the player basically tying the performance to?
Yeah, no, those are great questions. So to your first point, I would say, not everybody understands the stock market. Not everybody understands how to properly value Apple stock, right? There are two camps of people who invest in Apple stock. One camp is the person who is either trying to determine its earnings per share of 8.17 this quarter. And then there's another investor who really likes Apple products, right? And they're not necessarily going down to the granular detail of figuring out the earnings per share or the cash flow metrics that would properly value that stock. What they're doing is saying, I really think that Apple is a great company to invest in for the future, and because they make world-class products that design blah, blah, blah. And I want to put my money behind that for whatever period of time. The same could be said for, the Bengals. You may not know the exact mechanics of they're going to win. You may not go down to the granular detail of they're going to win 8.7 games with a, 3% probability to win the Super Bowl, et cetera. But you may think that, hey, they have a really good defensive line this year that's being undervalued by the market. So that that allows me to invest in the Bengals in an easy manner. So I would say that that's the sort of corollary, I would say, from investing in the stock market and investing in something like the ScoreEx team is you don't have to be super analytical but if you follow football and you have an information edge in some way, you can put that to use in this manner.
Got it. Okay. No, I think it might not be a good analogy, but I remember when the Snap IPO happened, everyone seemed to have an opinion, even those people that knew nothing about, IPOs or necessarily the stock market. But for some reason, I guess because it's something that a lot of people obviously use, they thought they knew exactly where the stock was going to go or wasn't going to go.
Exactly. No, that's exactly right. They had domain expertise in that, using that product, and, they may have been able to profit from that information from some mechanism. And so for your second question, in terms of how the mechanics of the exchange works, so these prices are traded on a market basis, just like the stock market, where buyers and sellers determine the market prices of these teams. So right now, the Browns are trading at $13 a share. The Patriots are at $25, $26 a share. But if the Browns go 5-0, those expectations for the team rises over the season to win the Super Bowl or to get into the playoffs, win the Super Bowl, etc. All those probabilities start to rise, and hence the share price starts to rise. At the end of the season, each team would then be cashed out for the amount based on the performance of them that year. So in the ScoreEx, a win is worth $1.40, and getting to the playoffs is worth a certain amount, and winning the Super Bowl is worth $8. So you can then quickly calculate the price of that team, what it's worth. It's liquidated once the season's over. You get that share back amount. So a simple example in this case would be if the team goes 8-8, that's worth $14 a share. So they wouldn't have made the playoffs. Say it was the Patriots. Then if you were holding a Patriots share, you would then get $14 credited to your account. Does that make sense?
Yeah. So is that purely peer-to-peer, or is there some component of it where the ScoreEx would need to be the house?
So it starts off with the ScoreEx selling off the shares, and after it sells off these shares, they're traded on a peer-to-peer basis, right? And so from the money that comes in off people buying the initial shares, we would then know exactly how much we have to pay out at the end of the season. Does that make sense?
Yep, got it. And how do you? There's seemingly going to be a liquidity problem if it's not adopted quickly. Have you thought that through?
Absolutely. That's why we're running it as a proof of concept this year, where it's completely free to play. You set up so this is a game that we played before, with just a few people, and it works. It's not as liquid as what we've made it into with an app and a real-time, robust trading exchange, but it works with just a few market participants. Where it gets exciting is when you get these real-time pricing updates. Say Tom Brady gets injured, you can then see the impact of that as people start to sell shares. And so obviously, the more people that are in the market, the better. But you really need either a few what we call market makers, guys who are continually buying and selling. These would be an equivalent of your high-frequency traders now in the stock market, who are picking up pennies every time you make a trade because you're misvaluing it. And these guys allow the regular person to just say, hey, I want to put in $20 into the ScoreEx and invest in some team and know that there's going to be accurate pricing going forward.
It's interesting. I remember reading Trading Bases, and Joe Peter mentioned they were doing something, I think it was at Goldman or wherever he was working at the time, with essentially season wins being the main metric they were sort of basing it on, and every Monday coming back to the office and having sort of a robust discussion for a number of hours about how their stock, for want of a better term, was doing or wasn't doing. And it sounds like what you've just mentioned, you don't need too many more than a strong core of participants playing to make it work, or make it viable, I should say.
Yeah, exactly. And what's great about this season is, anybody can go in and set up an office pool just like they would, just like they did in trading bases with your friends. Instead of a against the spread pick'em, you're now trading these stocks against each other. And hey, the guy with the highest portfolio at the end of the season is the winner versus the person who had the most against the spread picks in a traditional football pool would be the winner, right? And this has the benefits of having no deadlines, being able to trade in game, being able and just being real time, and having that exciting market component that allows people to get engaged and have more skin in the game whenever they want, as little or as much involvement as they want. So, it's a concept that a lot of finance people have done in the past on trading desks and things like that. But it's a concept that is really exciting if you bring it to a group of your friends and do it with each other. It's something that we strongly believe in, and what we want to make, and what we think can have a lot of benefits for the future of how sports betting evolves is sort of this mechanism where you don't have to know about point spreads or VIG or money lines or things like that. You can just use your domain expertise in the field of the NFL to determine whether you're buying or selling a certain team.
College football, there's a lot of alumni out there.
Absolutely. I mean, this is something we're starting with the NFL because it is the most heavily traded sport by a wide margin. But absolutely, I think this can apply to college football, college basketball, NBA, any other sport. And, we're continually taking feedback, and a lot of people want different sports. And we're just telling them, hey, we're doing it as an NFL for right now, but in the future, we definitely have plans to evolve to other arenas. So,
no, it's fascinating. So what's the best way to get involved? Do you have to be living in the US? Could you be anywhere? How easy is it to sign up? Can you just have, a trial period where you're obviously not using real money?
Yeah, absolutely. Right now, none of the ScoreEx is for real money. It's a trial period where it's structured as a game, right? A game component right now, where you play. You set up a pool against your friends. We're giving out cash prizes throughout the season for top participants who trade, who know the NFL really well and can trade really well. So completely free to sign up from that standpoint. Only U.S. and Canada right now because of those contest laws. But when we go to fiat currency, we expect to be in a lot of different places. But right now, if you're in the U.S. or Canada, you can download the app for iOS or Android, 100% free. And there's a lot of prizes you can win throughout the season. And set up a league with your friends to try it out, give us feedback, and we hope that this can sort of evolve the way sports betting is being done right now.
Before I let you go, a few topics / questions / word association that I'll throw at you. Seattle Super Bowl, Marshawn Lynch, run or pass?
Pass.
Emerging areas in sports betting here in the US?
Esports. Esports.
Kelly criterion. Is there anything about it that's flawed that needs to be fixed, or is it the best solution right now?
Being able to, it's impossible in its current form because it's impossible to calculate your exact edge. So taking a more conservative approach with the Kelly criterion is, I think, absolutely necessary in terms of quarter or half Kellys.
And lastly, best advice you've received, or the general advice you normally give to others who approach you and ask about sports betting?
Yeah, I think Yogi Berra said it best. He said it's tough making predictions, especially about the future.
There you go. George, I really appreciate your time. This was a lot of fun. We covered a fair bit and a lot of different topics, but I hope everyone enjoyed it. I certainly did. And it sounds like we might have to get you back on after the football season to follow up on ScoreEx, and there's a million other topics we didn't get to. So appreciate your time.
Yeah, absolutely. And if anybody has any questions, just George at thescorex.com. So whether that relates to sports modeling, if I can be of any help, or about sports betting exchanges, please reach out. So
awesome. Thanks a lot, George.
Thanks, Jay.